Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me today is Clint Sorenson, the Chief Investment Officer of Wealth Shield. Clint has been a long-time guest of The Resilient Advisor. He was very gracious with his time when I first started this podcast years ago. Did a regular series with me called Forecast Free, where we talked about what was going on in the markets through his lens. Clint, thanks so much for coming back on the podcast.
Hey, thanks, Jay. Happy to be here.
So Wealth Shield is growing exponentially. Let's start with what's going on at Wealth Shield.
Yeah, so we just, we set out with this goal to make maximum positive impact on the advisor on the client through the advisor. And we kind of captured, and we're lucky enough to be a part of this industry during this breakaway movement. So advisors leaving the wirehouses, leaving big firms. They don't have the resources when they get out into the independent space. And so kind of right place, right time magic. And we've learned to just support advisors as best we can. And we're devoted to them and devoted to giving them the tools and support they need to again, have a high quality end product for their client. And it's just caught on. And so we continue to grow, continue to add firms. We grew last quarter in terms of adding new firms, had a couple nice breakaways that had partnered with us, and we continue to launch new strategic initiatives and partnerships. Seems like every week. So we're very excited that what we do matters, and advisors are seeing the value in our efforts.
Yeah, Clint, your firm has your hand in a lot of different pots. You have a lot of different initiatives, but at the same time, you guys have been committed to advisor education. And for listeners and viewers, if you're interested in some cutting edge market commentary and thoughts on breakaway advising, head on over to wealthshield.co. That's wealthshield.co and sign up for their investment letter. Unlike other publications, there is high quality, actionable content in what they put out, and their research is second to none. One of your partners, David Stefanik, put out a piece recently on trend following, which hit home with me because I've been going on this educational journey to add more quantitative analysis into my work, and it was spot on. So Clint, let's start with your current investment framework right now at Wealth Shield and give listeners a little bit of a taste of what you see in the marketplace now.
Yeah, absolutely. So Jay, as you know, our investment framework starts with kind of this top-down view. We believe you don't have to predict, i.e. forecast free, don't have to predict what's going to happen in the business cycle to get a portfolio right. And so what we do is combine disciplines that have shown historical or empirical results that are exactly what we want, right? And so we've combined value investing, momentum investing, and economic growth or business cycle investing. And we use that in these 4 pillars that help us measure and map where we are within the cycle. Now, obviously, the cycle, quote unquote, is difficult to measure because there's typically multiple cycles. And so you'll see the beauty of the framework when I start talking about this. So the way we start to kind of ascertain where we are today is we start first with valuations. That helps us with the long-term cycle, right? Very inspired by greats like Warren Buffett, obviously, Seth Klarman. That's where I put my CFA hat on and start moving that direction. But that again is that 7 to 20 year period of time, right? Evaluations are so long-term. And so we have to have something for the intermediate term. That's where we incorporate economic growth and inflation data. And we're just looking at rate of change, year over year rate of change of key economic indicators. We measure exactly what the National Bureau of Economic Research measures, so the big 4, if you will. And what we're doing is just trying to measure and map whether business or whether economic growth is accelerating or decelerating, inflation's accelerating or decelerating. And that gives us a lot of information about how to tilt portfolios in the intermediate term. So think 2 to 7 years, right? And then we needed something for under 2 years. And so that's momentum. And that's where market sentiment comes in. And when we say market sentiment, often people think we're trying to be contrarian. Actually, we're trying to be in harmony with the market over that 0 to 2 year period. And so that's our short term, and that's our trend following component. And so when you combine all these, we have dashboards that kind of help us determine where the weight of the evidence is positioned, whether it's positioned taking risk, and then where do you take that risk based on economic growth and valuations. And then, or if you should be defensive, if you're defensive, where should you be defensive? Like, how should you allocate in a defensive environment? Should you be more in alternatives, or should you be more in treasury bonds, or what does that defensive environment look like? And so that's the way we built it. And that's what these four components are essentially our dashboards on measuring and mapping whether something's positive or negative. You can see market sentiment is negative, obviously, and it was deteriorating in February, and then obviously went hard negative in March. Monetary policy is off the charts as the Fed is throwing everything, the kitchen sink, the house, the neighborhood, all the empty lots, everything at this problem. And then market valuations have gone from really extreme in the U.S. To down to, still overvalued or highly valued, but a lot better than where we started the year when you look at, long-term historical valuation measures. And then economic growth, we were slowing heading into this before the coronavirus, and now we've deteriorated even further, and you'll see that moves more toward the red at the end of this month.
So the framework as it's shown on the screen today is as of March 31st. What I love about this journey I've been on with Quant is it's not about making decisions intra-month or intra-quarter. There's a timestamp for it, and it gets rid of some of the irrational behavior. But for you and your team, when you look at this framework, is it a monthly assessment or a quarterly assessment? And if so, how volatile are each of these four components?
Yeah, so we adjust this every month. Obviously, some of the economic data comes out quarterly. So we adjust what we can monthly, which would be like leading economic indicators, whether it be the ECRI or the Conference Board, other monthly reported series like retail sales, et cetera. We'll update that monthly. But that doesn't get the full weight of the evidence until you get nominal GDP and a lot of what's reported quarterly. So it's all looked at monthly. But again, you got to remember there is a lag to some of the data on the economic front. Valuations, we look at monthly. Monetary policy is obviously as it comes out. And that's just really, if it's green, it means you're expanding the balance sheet, or the central bank is. And they're also cutting interest rates, which they're doing both of. And then market sentiment is the most volatile. That shifts monthly, but it probably moves more than any of the other components, as it should be in a 0 to 2 year piece of our framework.
All right, so here's the research nerd in me, and because this is my new passion, could we go a little deeper on the 0 to 2 year framework without giving away the?
We'll give it away. We actually published the paper that you were mentioning that David Stefanik published. We literally give away the formula. We've been open source since day one. We publish a lot of what we do in the form of indexes or whatever. We want advisors to have all the information they need to make great decisions. So we're very open source. I don't mind giving it away. So David published that paper, and you can find that or send us an email via our website and we'll send it out. But he published a paper on market sentiment, and it literally showed how we measured it. And what we do, each of these different components or on this grid is essentially looking at high yield bonds. So we're looking at the credit markets, risky credit. We're looking at international equities, so call it ACWI ex-US. And then we're looking at domestic equities, so call it like Russell 3000. And we look at those on an absolute basis, so relative to themselves over the past 3, 6, and 12 months. Are they positive or not? That's one simple way. Then the next thing we look at is whether relative to a risk-free asset, which we use, 7 to 10 year Treasury basket here, whether they are positively trending or positive relative to that asset. So very similar to, I know you had Gary Antonucci on your podcast. If you remember in dual momentum, he kind of compared on the absolute momentum front in his paper, he compared the S&P or the stocks to like T-bills, right? So to get whether it was positive or negative, we just use 7 to 10 year because it's a little closer to duration. Duration is like 48 to 50 on the S&P. So what we do is then compare that on 3, 6, and 12 months. And if it's negative across the board, you're in the red. If it's, maybe absolute positive, but negative relative risk-free, which is what we saw a lot of heading into this year, you're more in the orange to yellow. And then when you are both positive relative to the risk-free asset and positive on an absolute basis on the majority of the time frames, you're in the green. And so we look at those three asset classes in similar fashion. And then it tells us a lot about whether we're trending on short, intermediate, and long term, which we use 3, 6, and 12 months. And we say 0 to 2 months because that's where momentum works the best, right? So it starts to fall off at about 2 years. And so we use, when I say 0 to 2 years, that's really what I'm talking about. It's just the efficacy of momentum investing and where it starts to fall apart.
As a novice, and now that I've been playing with models for a couple of months, it just seems too easy right now in this environment just to go to a straight 3-month signal because of the high volatility. I know I'm wrong. I know there's academic research that proves I'm wrong. Tell me why I shouldn't do that now with my models, Clint.
Yeah. I mean, just like this framework is diversifying system, we think it's really important. One of the people that has influenced me probably more than anything is Jerry Parker. He was an original turtle trader. He's just influenced me probably more than any professional. And when I talk to him, there's so much importance in diversification. It's not just diversification like stocks, bonds, other asset classes, although it's important. You need to diversify by system as well and by rule set. And so I know Corey Hofstein talks a lot about that, and he did a marvelous job on your podcast discussing how he diversifies his systems. But that's what we've done with the framework. That's what we also do within that component. So we don't just use one valuation metric. So we're not just looking at the cyclically adjusted price to earnings ratio, right? We're looking at that plus margin adjusted, cyclically adjusted price to earnings ratios, plus market cap to GDP. And in momentum, we do the same thing, looking at multiple different systems, 3, 6, 12 months, multiple asset classes. We want to diversify as much as possible so that we can weigh the evidence. And we feel it just gives you a better decision quality.
So in the paper that David Stefanik wrote for you guys at Wealth Shield, he did a great job of articulating the difference and the reasons why you would want to use the Sortino ratio over the Sharpe ratio. And I think sometimes that can be confusing to investment advisors. Could you walk listeners through why you guys put more emphasis on the Sortino ratio?
Yeah, because volatility is not risk. Volatility is fluctuation around an average. And if someone said, hey, here's your average return historically, and I want to give you all the upside fluctuation around that average, I'd say, give it to me right now. I'll take it. I'll pay for that. I want that. I want that upside volatility. And so when that gets grouped in with downside volatility as a risk measure, it's just inaccurate in our opinion. Plus, I think risk is falsely defined anyway. I mean, risk is the probability of not reaching a financial outcome, in our opinion, right? So when we support advisors, we're trying to limit that. Right. So that's building portfolios that are behaviorally palatable. Right. I know it's something you and I share a lot of passion about is behavioral finance and how to apply it, practically. And so our goal is not to manage volatility. Our goal is to manage real risk. And Sortino ratio gives us all the downside volatility. That's exactly what we want to avoid. In a perfect world, we cut all that out and we take all the upside vol. And so we use the Sortino ratio as a better measure for risk, even though it's not really a risk measure, better measure of volatility in a portfolio. And so we want to maximize return per downside volatility. And so Sortino ratio is the way we score it.
Yeah, just a much better measurement. Listeners and viewers, please head over to wealthshield.co, sign up for the list, and get a copy of that paper. It really is a comprehensive work. All right, Clint, let's go old school.
Yeah.
Used to on the Forecast Free series, I'd just throw something out and you had to respond. You get nothing in advance. Are we having a bear market rally or is this a new bull market?
Yeah, the best answer is I have no clue, right? I don't even know how people define it anymore. But in our opinion, I think we're in, if you look at the trends of things, if you look at our framework, that's very supportive of that bear market, quote unquote. So that's where the weight of the evidence supports that. And so that's where I have to throw in my bet.
All right. Take your quant hat off, please. Gold. Do you own it now or do you not? If you're a financial advisor allocating portfolios,
it's in a positive trend. And I think if you look at it fundamentally, there's never been I couldn't make a better case for gold with what's going on fiscally, what's going on from a monetary policy perspective. However, if the trend was negative, I would say don't own it. So the trend's positive. If you look at what's trending positive, it's gold, it's treasury bonds, it's the US dollar, it's other types of bonds, not high yield, but high grade corporates, high grade munis, et cetera. So as long as it's trending positive, I say you own it.
All right, let's keep the trend hat on and talk about dividends and potential dividend cuts. How do you look at that through your lens?
Yeah, so one of the areas we try to steer clear of are high dividend strategies. We like dividend growth strategies. Reason why is because if it's embedded in the corporate culture to increase dividends for a long period of time, that's a tough decision to go ahead and move to cut, right? And also, you just got to do your work at the fundamental level to make sure companies aren't borrowing to pay their dividend. You're going to see a tremendous amount of dividend cuts, just like you're going to see a tremendous amount of insolvency, and in particular in the energy patch. So, yeah, I mean, you're gonna see quite a bit of it. This is what happens during this part of the cycle. I think if you've stuck with companies who have it in their corporate culture to reward shareholders through dividend increases historically, I think those names have a higher probability of keeping their dividends up, at the current level. I don't know about increasing them. Like IBM increased it by 1 cent the other day. It's funny, but yeah. So I mean, you can see these companies keeping their dividends. However, there's going to be a lot of organizations who have had a high dividend that have to cut it.
Well, and I would think given the power of indexes, a lot of these companies want to remain in the indexes of having, increased their dividends 10 years so that they continue to see that type of flow, even if it's by a penny. Is that something in line with what you would expect to see?
Absolutely. I mean, if you look at like the Russell 1000 dividend series, which obviously we created the Eco 8 series of that with the momentum overlay. The Russell 1000, 2000, the mid cap. These are all companies who increased their dividends 10 years running. S&P Dividend Aristocrats 25 years running. Companies not going to just go out and cut the dividend after being in that index and attracting a lot of flow because of their participation there.
All right, last trend question through the forecast-free lens, the Fed. Now, I want to put some context on this. I have a lot of clients that use Wealth Shield services. They use your fixed income sleeve that you've done a great job with. And don't speak specifically to the sleeve. How do you play that from a trend perspective, though?
Yeah, I mean, it comes down to what's trending positive, right? At the end of the day, and some of our fixed income sleeves can rotate between high yield, high grade treasuries, or cash, or what have you. A lot of those have been in treasuries because that's where the trend is, right? Trend's positive in treasuries, not positive in high yield. And even though the Fed stepped out and said we're going to buy everything, including high yield bond ETFs, high yield has not exactly responded like we thought it would, due to the fact that they're buying it. Now, LQD, on the other hand, did, right? Corporate bonds, high-grade corporate bonds, man, they got a lot of buying, to the point where they went from trading well below NAV, net asset value, to trading well above NAV, just based on the announcement that the Fed was going to be buying these corporate bond ETFs and corporate bonds themselves. So, I think at the end of the day, it is what it is. They are the biggest player in the market. And so from a trend perspective, if it's trending higher, I'm going to own it. I don't care who's the buyer. Right price discovery doesn't exist anymore, in my opinion, due to the fact that the Fed is in the market. And if it's in high yield, I'll be in high yield. If it's in treasuries like it is now, we'll be in treasuries. So the good thing is they're buying everything. And as you know, Jay, a lot of our work has been done on credit spread. So we create a lot of credit spread related systems. And it's funny, I was really bothered when the Fed stepped out and said, and this is my emotional ego side, right? Fed stepped out and said they were going to be buying high yield bonds and high yield bond ETFs. And I was thinking, well, that's going to mess up my calculation, right? But then I started realizing they've been buying the denominator, right? They've been buying treasuries for a long time. That hasn't exactly stopped. So, and they're buying more of that now with the expansion of their balance sheet. So they're just buying everything. So, I got over that really quick, but I got emotional the first time I had heard that they were going to be supporting high yield debt. I just thought, man, that's the end of free markets, in my opinion. But I'm back. I'm back to following the trend and sticking to the discipline.
That's the beauty of trend following and why
Right.
I've developed such a passion for it. It takes away, your biases. It takes away any type of forecast that you made, and being right or wrong about it doesn't matter. My favorite line in this whole trend following world is, do you want to be right or do you want to be rich? And you just got to follow where the trend is. And along those lines, that's really driven me to start dissecting models and trying to understand them. Let's go through one of yours.
Yeah.
So here's an index you guys created called the Wealth Shield Sector Index. And we can keep it high level for the purposes of this broadcast, but walk us through the construction and the rule set.
Yeah, so this is actually a pretty complex rule set. So what you're looking at is you've got trend following combined with this risk on, risk off overlay, which is essentially credit spreads. But what you're looking at is essentially high yield relative to treasuries, right? So that's what a spread is. You're looking at those two, and you're saying, hey, if spreads are widening, where in this case high yield would be declining relative to treasuries, you're going to move into a risk off posture. Let's look at that every month. If you're in a risk off posture, you can be in long-term treasuries if they're positively trending. You should just use a simple moving average system there. Or you can be in cash if it's in a negative trend. So that's your risk off decision tree. If you're risk on, you can be in sectors. So it picks the top 5 sectors by relative momentum. In those sectors, it just ranks and then selects which ones to be in. And then if you're in those top 5 sectors, they have to be positively trending. If they're negatively trending, you can be in cash. And so we designed it to be pretty robust given the different environments. So you have one environment would be, let's say inflation, right? Well, hopefully inflation would be triggered by moderate growth as well. So growth's moving up, inflation's moving up. In that environment, you should be in equities, but you also have that trend following filter just in case that particular sector is not favored. You could be in cash. So when you risk on, you can only be in equities or cash. Then the flip side is, let's say we go risk off because growth is slowing. Hopefully that's reflected in the credit spread, risk on, risk off piece. If it is risk off, then you can be in long-term treasuries. That's when economic growth is really slowing and inflation slowing, or maybe you get a stagflationary environment where inflation's running and you don't need to be in long-term treasuries because they start trending down. So we built it to be robust to cover that inflation, disinflation, deflation, stagflation type regimes, those 4 different quadrants. And that's how we built it. And, it does its thing, right? It doesn't always look like the market. So it's difficult for people to follow. Like in a 2019, where if you missed the first couple of months because you're risk off at the end of 18, where it shines, right? It does a great job. People are going to be pretty disappointed if they're looking at stocks as the benchmark for this. It's meant to be that trend following component of our portfolio.
And that's a very important aspect of trend following that I'm learning. It's very easy to look at the shiny performance sets, and it's very, very easy to look at some of the simplicity of the models. But even Gary, when he was on talking about, dual momentum and where it doesn't work, it's just as important to understand when it's not going to work. Periods of sideways market, some of these strategies aren't going to work. Periods of increased whipsaws is going to be incredibly difficult. And knowing that in advance helps you build out the diversification of the models. Is my understanding correct?
Absolutely. That's why you want to diversify by system too, because they're not always going to work. And you want that to be the case, right? I don't want it to look like the market. But it's hard when you're adopting it as an advisor for a client. It's hard for the client when something doesn't look like the market because we're so anchored to what the S&P or the Dow are doing. And so that's why what's behaviorally palatable for a client is not mathematically optimal. I know you've heard me say that before. What's mathematically optimal, in my opinion, is everything in trend following, right? Makes sense for me, but that is not behaviorally optimal, right? A typical client who doesn't understand that cannot stick with trend following for even 50% of a portfolio. So typically what we find is that it's optimized at somewhere between 20 and 40% of an overall allocation as a satellite position. And there needs to be a lot of education done, the higher the weighting there. And for an emotional client type, it's not always a fit, right? This is more for your logical investors who can be educated. But clients emotional about money, it means you can't educate them. You have to adapt to their personality, their money personality. And so when that's the case, when they're emotional, you probably need to second guess having anything they don't understand in the portfolio. That's when you want to just use traditional asset allocation. In the book we feature that we wrote in 2015, that was that valuation component. It's so simple. You just look at the CAPE, and in the CAPE, you just say, hey, if the CAPE's high above and we use the 30-year rolling median in the book, but I mean, you could just look at it historically. Like if it's in the top quartile, I just want to be in a lower equity allocation. Like in the book, we went from 30-70 to 70-30, but I just did a test the other day going from 40-60 to 80-20. The worst year just following that was down 2.98%. Max drawdown's like 17%, and it compounds at right close to what the market's returned. So I think it's 9.9%, and the market's at 10.12 since 1985. So sorry, I was going through memory on those numbers, but it's probably pretty close to what it actually is. And when you look at that, it's like, wow, I can get the market-like return, and most of the time I'm in a 60-40 portfolio. So something like that's probably better for an emotional client than adding trend following to it. And in the book, we feature an example of using valuations and then incorporating trend following also as a piece of that to help to help balance the times where valuations are high for extended periods, like think late 90s, or think this most recent time period. And when valuations are high for extended periods and you're automatically underweight, you have this piece of the portfolio that can shift you up to the benchmark. And that's really the goal. I listened to Corey on your podcast talk about the same thing. He talked about straddling the benchmark, whereas trend following can be that throttle that gets you up to, maybe it's a 60-40, gets you up to 70-30, or gets you down to 50-50. And that's exactly what the goal is when we build portfolios as well for advisors and their clients, to try to get them to straddle that benchmark.
Yeah, Corey did a great job articulating that on the podcast. And viewers and listeners, I encourage you to pick up a copy of Clint's book that he wrote with his partner, Robert Leggett, called Invest to Prosper. The data that Clint's referencing right now, it's in the book. But what I really found impactful with that, Clint, is that actually for somebody that's new to trend following and new to quant, I could digest it if I was a retail investor, as well as if you're an educated financial advisor going down this journey. Let's wrap up with this, because we've gone over our time here. Any other applications today in the age of coronavirus that you think financial advisors could pull from your book, Invest to Prosper?
Yeah, I mean, just how simplicity is the ultimate sophistication at the end of the day. That's the whole design is, I think the measure of intelligence is how you can take a complex topic and make it as simple as possible. And that shows you how I lack intelligence, because that is not my strong suit. However, I tried to do that in the book as best I could, right? And so I think just find a system. And my friend Michael Gayed says this best of pension partners. He said, it's not the system that's important, it's the ability to stick to the system. And the way he says it is far better than I just did. But essentially, he says the sticking to a system is more important than the system itself. And I agree with that. I think the best thing you can glean from this book, from Gary Antonucci's book, from anything Corey puts out. I know you got Wes on your show tomorrow. Anything he puts out, anything from JC from All Star Charts, anybody who puts out good work and good research. I think at the end of the day, what we've got to glean from that is, how do we build a system that's simple, that I can follow with discipline? And it's the simplicity and the discipline that matter most, not the system.
Excellent. Clint, thanks so much for coming on again. Listeners and viewers, head over to wealthshield.co. That's wealthshield.co. Sign up for the research. You will not be disappointed.
Thanks, Jen.